Wow. The Nasdaq Composite plunged 1.81% today
Its worst single-day performance in weeks.
in weeks, and the selling pressure was so pervasive, the S&P 500 is now on a 4-day losing streak. It fell another 1.16%.
Yeah, and today's action, it wasn't just a simple risk-off day.
No.
It felt more like a violent rotation. I mean, it really laid bare some of the fractures that have been forming just beneath the surface of that big rally we've seen.
A violent rotation is the right way to put it, because we've seen losses for 4 days, but today was just extreme divergence across every asset.
And that's the core puzzle, right? Was this just investors fleeing stocks in general, or was it something deeper, like a philosophical shift in how the market views the whole AI infrastructure boom?
The anxiety is definitely rising.
Yeah, for sure. You can see in the VIX, it surged 6.92% today, up to 17.62. That tells you people are finally starting to price in risks they've been maybe ignoring for a while.
Which brings us right to the epicenter of all the pain today, the tech rout.
Mm.
Technology saw a brutal 2.22% decline, the sector's worst session in weeks. And the immediate driver seemed to be a report that struck right at the heart of AI financing.
Exactly. The catalyst was that report about Blue Owl Capital.
The big private credit firm.
Yeah, that they were potentially withdrawing from financing Oracle's massive $10 billion data center project up in Michigan.
And it doesn't even matter if the report is 100% factual, just the idea that a major lender is getting cold feet.
That was enough. It sparked contagion. It crystallized this skepticism that's been building around AI capital expenditures.
Right. It feels like we went from a market philosophy of AI at any cost to suddenly asking, wait, can we actually afford this? Is the cost of capital getting too high?
And you saw the result immediately. Oracle dropped about 5.4% on that news. But the real story here isn't just one stock. It's the technical damage done to the major indices.
This is what really matters, I think. Beyond the daily headline, we saw some really meaningful technical levels get breached today. This wasn't just a blip.
Not at all. Look at the S&P 500. It fell below its 50-day moving average for the first time since late November. That level was 65.20.
And for momentum traders and systematic funds, that 50-day is the line in the sand, isn't it?
It is. Breaching it often triggers programmed selling. It signals a real shift in short-term momentum from bullish to, well, corrective.
And the Nasdaq looks even worse off. It's now trading, 1.85% below its own 50-day MA?
Yep. And maybe more importantly, it's now 5.52% below its 52-week high. That's a genuine, measurable setback in investor sentiment. That takes a lot of buying power to repair.
So it all connects back to that philosophical shift. We are officially moving from AI at any cost to...
Just show me the returns, exactly. If those future cash flows are suddenly less certain, the market has no choice but to mark down the present value of those high-flying stocks.
So when that long-duration growth story breaks down, where does all that cash go?
Well, that takes us to the great sector divergence.
It was just stunning to watch in real time.
It was an extreme move. You have technology plunging 2.22% on one end of the spectrum.
And on the complete opposite end, energy stocks jumped 2.21%.
Right up to $44.78.
That's a 4.43 percentage point spread between the best and worst sectors. That has to be one of the widest single-day divergences we've seen all year.
It really proves this wasn't a simple sell-off. This was a massive, targeted rotation of capital from one area to another.
And what was driving energy?
Crude oil. WTI crude rallied 2.68% to $56.75, and Brent was up 2.87% to $60.61. This wasn't random either. It followed reports of new supply disruptions related to Venezuela.
So that just layers more risk on top of an already tight supply picture, with OPEC plus still holding the line.
Exactly. So some of that tech money went into a pure risk-on commodity like oil, but a lot of the rotation also went into classic defensive havens.
Okay, so where did the money run for immediate shelter?
Consumer staples led the way, gaining 0.47%. Then you had real estate up 0.44 and materials up 0.42. It's a very traditional flight to safety playbook.
It's interesting that real estate, I'm looking at the REIT ETF, VNQ, which was up 0.37%, managed to do so well.
It is interesting. It suggests investors are finding refuge in sectors that are sensitive to rate stability. They don't seem to fear a massive spike in interest rates, just volatility in tech.
A fear in growth? but conviction and value in tangibles.
That's the signature of today's market action.
And speaking of tangibles, we have to talk about precious metals. Silver, specifically, had an unbelievable day.
Unbelievable is the word. Silver surged a colossal 4.38%. It closed at $66.47.
And that extends its rally for 2025 to, what is it, around 120%.
Approximately 120%. I mean, just think about that. A 120% return in a single year for a major metal. That is a historic move. It's way beyond simple inflation hedging.
So what's driving it?
It's this dual catalyst story. Silver is benefiting from huge industrial demand. It's essential for solar panels, for EVs, and yes, for the massive build-out of AI data centers.
Right.
And that's happening at the same time you have the traditional investment flows coming in. Gold, for its part, also had a good day, up 0.86% to 44.50.
So what does the gold-silver ratio tell us about all this?
Well, the ratio compressed today down to 65.36. That's near multi-year lows. What that tells you is that silver is behaving less like gold's little brother and more like a critical industrial commodity.
Yeah.
The physical demand is just that strong.
But this also reveals a contradiction, right? Precious metals and equities moved in opposite directions, which is a classic risk-off signal. But at the same time, energy commodities rallied sharply.
Exactly. This defies a simple macro story. It tells us investors aren't panicking systemically. They're making targeted, selective bets. It's conviction-driven rotation, not a blind flight to cash.
And we have to mention the biggest outlier in the whole commodity space.
Yes.
While metals were soaring, coffee plunged 8.46% to 347.20.
A huge move. The largest single commodity decline of the day. Bit of a reality check there.
Definitely.
Now, let's contrast all that volatility with the unusual calm we saw in fixed income. The 10-year Treasury yield, it held perfectly flat, 4.150%.
Why is that lack of movement so important?
Well, if the S&P 500 is selling off this hard, you'd normally expect a massive flight to safety bid into treasuries, which would push yields down.
But we didn't see that.
We didn't. And the absence of that bid suggests the selling was very sector-specific. It was concentrated in tech and long-duration growth. It was not a reflection of broader concerns about the macroeconomy.
And the yield curve itself is still looking pretty healthy.
It is. It maintained its normal shape. The 10-year, 3-month spread is still positive at plus 61 basis points. That's actually the healthiest the curve has looked since the Fed began its easing cycle. It really backs up the idea that this was a rotational shakeout, not a systemic panic.
Okay, now let's pivot over to cryptocurrencies. They just continue to show this persistent weakness, decoupling from pretty much everything. Bitcoin was down another 2.17% today, around 85,825.
The decoupling is really striking. This is the third straight week crypto has failed to participate in any kind of risk-on move, and it keeps falling, even when safe havens like gold are rising. Bitcoin is now sitting almost 32%, 31.87% to be exact, below its all-time high.
So if it's not tracking macro risk, what's driving this?
You have to look at the internal sentiment. The crypto fear and greed index is at 16. That's deep in extreme fear territory.
So this is structural.
It seems to be, yeah. We're likely seeing continued institutional redemptions, unwinding of leverage, basically structural deleveraging. It's its own story, independent of what the S&P is doing.
All right, so as we look ahead, we have to remember the backdrop here is still last week's Fed meeting.
Absolutely. That hawkish cut continues to be the dominant driver, especially for the pressure on tech.
Right. They cut the rate, but the projection of only one additional cut in 2026, that higher for longer message, is what's really doing the damage. It fundamentally increases the discount rate for growth stocks.
We did get a little bit of a counterbalance today from Fed Governor Waller, who talked about room for rate cuts. And his comments were sort of supported by that delayed data showing October payrolls fell by 105,000.
And unemployment ticking up to 4.6%?
Yeah, but even with all that, the market still seems to believe in higher for longer. The probability of a rate cut in January is still really low, only around 24%.
Okay, so we've had this major technical break, this violent rotation. What are the immediate catalysts that could either stabilize this market or accelerate the selling?
Well, tonight is absolutely crucial. We get earnings from Micron Technology after the bell.
A huge insight into semiconductor and AI memory demand.
Exactly. Their guidance on capex and demand will be watched incredibly closely. And then tomorrow we get the November CPI data. That's probably the biggest release of the week.
So an upside surprise there, a hotter inflation number could really pour gasoline on the fire.
It could. And then don't forget the global picture. We have the Bank of Japan meeting this week. A 25 basis point hike to 0.75% is widely expected, but any surprise there could trigger volatility across asset classes.
So if you had to synthesize all of this down to one key takeaway from today, what would it be?
I think the single key takeaway is that the market's relationship with AI is fundamentally changed. The era of just granting the sector the benefit of the doubt on future returns. That's over. Investors are now demanding proof.
And I'll leave you with one final thought. The S&P 500 is now trading below its 50-day moving average, which is a clear technical warning sign.
Mm-hmm.
But the VIX, even with its surge today to 17.62, is still below its longer-term average of 1848.
That's a fascinating contradiction. It suggests traders are hedging near-term risk, but they're not pricing in sustained systemic panic. Not yet, anyway. It leaves the door wide open for either a quick stabilization or more selling.
Which means everything really depends on Micron tonight and that CPI print tomorrow.
It really does.
All right, I think that covers today's action and that extremely deep sector divergence we witnessed.
Indeed. That was the daily consolidation for today. And as always, please remember that all of this is for educational and informational purposes only.
That's right. It is not financial or investment advice. You should always conduct your own research before making any decisions.
And if you found this helpful, please do hit that subscribe button. We are here every trading day after the close.
We'll talk to you next time.